Hey, everybody. Tim Ulbrich here alongside Tim Baker. Welcome to this week's episode of the Ask a YFP CFP segment of your Financial Pharmacist podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into this week's question, I want to give it a shout out to YFP Planning's incredible team that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to optimize your investing plan, pay off those student loans, or simply build a solid financial plan, YFP Planning will help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Before we jump in as well, just a reminder that this is not intended to be investment advice. And so with that, we're going to get started with this week's question, which is from Jenny in the YFP Facebook group. Jenny asks, where should I start if I have a bit of money to invest? I've never done any investing before other than my 401k. I've read a bit about a REIT, but not sure how risky that is or how much return there is. Tim Baker, what are your thoughts?
Yeah, so this is a great question. So first, we're kind of talking about two different things. One is a REIT is a particular type of investment. And I think we're also talking about where else outside of my 401k should I invest, which is kind of like the vessel or the vehicle. So I think first and foremost, we'll kind of address the vessels first, and then we'll kind of go back to the REIT. I'll finish the question there, Jenny. So I think the first thing is, if we look at all the buckets that are available to you, one is to kind of look at the 401k. And I would say, unless you're maxing out the 401k, which we're kind of in between tax seasons now, Tim, 19,500 last year for 2021, 20,500 for 2022. I would just stay there. So I would, log into your 401k, crank up that, percentage to get to that 19,500 and call it a day. That's probably what I would do. Now, the nuance there is, like, if you have a not so great 401k, then maybe we don't do that. But that's probably the first place that I would look. The second place I would probably look, and maybe even before this, I would look at the HSA. So that's another vessel, another, avenue that if you have a high deductible health plan, you get the triple tax benefit, you put dollars there, and you can invest it just like a 401k or an IRA. The second or the third piece that I would look at, Tim, is the traditional IRA to Roth IRA. So this is a scenario. If Jenny is like, all I have is my 401k, then hallelujah, we can do a contribution, a non-deductible contribution to an IRA, assuming that we're over the income threshold limits. 208,000 if you're married filing jointly, 140,000 if you are a single taxpayer, where you're above that to put money directly into a Roth, Jenny. So you have to make a non-deductible contribution to an IRA and then backdoor it to the Roth. So the reason I say that this is a scenario that it would work is because what people forget, what investors forget, Tim, is that you have to account for the aggregation rule. So the aggregation rule says that if you have an existing SEP, simple, or pre-tax IRA, that you have to basically account for that before you can make the 100% contribution over to the Roth. So if we assume that she doesn't have that, Jenny, you don't have that, what you would essentially do is that you would open up a traditional IRA, you would open up a Roth IRA, you would make a non-deductible contribution to the traditional IRA, you would wait some period of time, some say 30 days, some say 365 days, and then you would backdoor it, or you would roll that money from the non-traditional or from the traditional IRA to the Roth. And then you'd be able to do 100% of that. So now that 6,000 in this case would go from the non-traditional right into the Roth. And because you don't have all those other pre-tax accounts, you don't have to worry about what actually you have to pay tax on that 6,000. And then you could do that year over year until, potentially they change the laws, which they've talked about that here recently. So that's the case where, again, it's a little bit easier. And you might be saying, Tim, like, what are you talking about? Because that doesn't sound easy, even in that scenario. I get it. The other thing that you could do outside of the IRA is the taxable account. So this is an account that you can set up with any custodian, Vanguard, Fidelity, Schwab, TD Ameritrade, and you open that up, and basically you put the cash in there, and then it grow. You can put as much as you want in there, and then you invest it in whatever securities that you want: stocks, bonds, mutual funds, ETFs. The big difference with that is that you pay capital gains on that. So short-term capital gains, if you buy and sell it, or if you buy it and then sell it less than a year. Long-term capital gains, if you hold it for a year or more. So that's important to understand. And then other considerations, Tim, would be things like FSAs, depending on if you have kids, FSA for dependent cares. If you have kids, it could be education accounts. And then, could be direct real estate. Now, one of the things, Jenny, that you mentioned is what about this REIT thing? So a REIT, it stands for, so REIT stands for Real Estate Investment Trust. And these have been around for 60 some years. I think they established these in the early 60s, Congress did. That really allows individuals to invest in large scale income producing real estate without actually having direct ownership of it. So Tim, we're real estate investors. We buy an apartment complex here in Columbus, and then we sell shares of that to the average investor. So we own it, but then they actually own shares of it. So it's almost like a mutual fund for real estate. And you would own these, in some of these accounts that we talked about. It could be your 401k, it could be an HSA, an IRA. And it's kind of for people that want real estate exposure without actually owning it outright. So just think of it that way. And, typically they're not supposed to be correlated with the regular stock market. So that's a benefit. Some people just like to have real estate in there. I would say it's as risky. It can be as risky as an equity portfolio. So you can have a REIT that owns properties that default, that, don't necessarily pan out. So, you typically want that to kind of diversify your portfolio a little bit, or if you have an interest in real estate, but you don't want to hold that directly. So those are all the things. So kind of understanding the different buckets available to you, Jenny, but then also understanding like what goes into those buckets, REITs being one of those things, is really kind of the answer to the question.
If we think about real estate investing, Tim, on the passive to active side, people I think often think of, I'm going to buy a property, I'm going to hold it, maybe I'm going to manage it, deal with the repairs, right? Obviously that can be more active, although there's systems and solutions that can help that. REIT would be on the passive side, right? As we look at options that are out there.
Yeah. Sometimes when we talk about real estate investment to clients, they're like, oh, I'm kind of interested in real estate. But then we kind of go through all the different things that you can do in direct ownership and kind of being a tenant or being a landlord to tenants. If we get to the end of that and you're like, no, thanks, bro, not for me, then I would say, invest in REITs. And typically our models with at YFP Plan and have REITs have a real estate component in it, because again, for those reasons. Typically the more active or the more hands-on you are with real estate, the more benefits you get from a tax perspective. The further you away, more passive, the less benefit that there is. So that's another thing. You don't typically get the benefits that, if you have a direct ownership in a piece of real estate. So but it's a great question. I think, a lot of people, and it could, again, it could be as simple as, oh, wow, I'm only putting 5% into my 401k to get the 4% match. Maybe I just, put that to 10, 15, 20%.
Yep.
Get that to where it needs to be before I start doing all this other stuff. The only other, I think, exception to that would be maybe to look at an HSA if there is a high deductible plan because of the tax benefit.
Great window to learn too, Jenny. I think it for Jenny specifically, but also others listening, if you're looking to dig into more of, lots of the terminology that Tim threw out there in terms of the HSAs, the brokerage accounts, other investment options, a few resources I would point you to. We'll link to all of these in the show notes. Episode 72 through 75. We did a kind of a crash course in investing, looking at some of the alphabet soup of retirement planning, investment planning. Chapters 12, 13, and 14 and 7-Figure Pharmacist. We talk about some of the saving principles, investing basics, tax favored investment accounts. And since Tim mentioned the Backdoor Roth IRA, episode 96, we'll link to that in the show notes as well. With the caveat that, folks may often think that is easier than is to execute, and to make sure the T's are crossed, the I's are dotted. I think that's another great opportunity to connect with the team at YFP Planning. So Jenny, really appreciate you taking time to submit your question. We're going to be sending you a super comfy YFP t-shirt as a small thanks for you submitting that question. And for folks that want to have a question featured on an upcoming episode, you can email us at info@yourfinancialpharmacist.com, or you can record your question by visiting yourfinancialpharmacist.com/ask-YFP. As we wrap up this week's episode, an important reminder that the content of this podcast is provided for informational purposes only, is not intended to provide and should not be relied on for investment or any other advice. Information on the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. You can learn more information about this disclaimer by visiting yourfinancialpharmacist.com/disclaimer. Thank you again for those that have listened. We appreciate your support of the podcast and have a great rest of your week.